We're half an hour from the open in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Avril Hong in Singapore.
And I'm David Ingles here in Hong Kong. Let's get to your top stories today. Investors across the Asia-Pacific in a, fairly defensive mood, even with global stocks close to reversing all their losses since President Trump's so-called Liberation Day. Now, the dollar and treasuries are firming as traders look past weak U.S. consumer confidence. Now, Donald Trump marking 100 days in office by resuming his attacks on the Fed chair while again saying his China tariffs will force Beijing into a trade deal. And we get China PMIs this hour set to show early trade war damage to the economy, with the factory gauges expected to slip back into contraction. Good morning and welcome to the show. Midweek session, and we're just in the thick of earnings season. Again, in the thick of the busiest earnings week in the Asia Pacific so far for the season. And as you can see, mostly to the upside as far as equity markets go. We're gravitating slightly higher, although not really getting a lot of volumes coming through. Just to note as well, so Samsung broke down some of the earnings coming through. Chips, of course, very much in focus still, given the sort of back and forth we're getting there. So on price, we're better. In fact, at 185 right now, we've completely reversed, in the Asia-Pacific gauge specifically, this one, completely reversed all the losses from Liberation Day. Right. All that being said, though, dollar is softer. Yields are also softer, as you can see there on your screens, 2s and your 10s, by about, give or take, by about 1 or 2 basis points each. Let's have a look at where we are as far as the approach to China is concerned, right? So while this has reversed completely, some of the benchmarks here in Hong Kong are not close. In fact, it depends where you look. Now, all that said, bucking the trend overnight of that sort of rally we had on Wall Street, which I think is now the longest streak in several months now on the S&P. Lower on this, couple of stocks, of course, you want to be paying attention to, like XPeng going into the open today. About 86% through earnings season so far, and the approach to the open is looking like this. So today we get HKX, we get Yum China, and Prada, of course, which is also listed here in Hong Kong, also will also be reporting earnings today. And we'll be unpacking, certainly, and also any sort of market reaction, if you will, to some of the earnings that have come through, including, of course, the banks and the thinning on the margin space. Just one thing to note, right? Reason we have copper in here, so this is copper in Shanghai. That's the price. There's a separate but related gauge, which is the premium you get at Yangshan port. That premium is actually a 16-month high, which I guess is an indication maybe that below the surface there are bright spots as we go into, I guess, what seems to be Avril. Again, another day where we're moving slightly away from the edge as far as the tariff story goes. But we'll see.
Yeah, that sense of de-escalation, right? But to your point, we will see, because when it comes to Trump, he's not only doubling down or moving away from that narrative on China, I should say, but also renewing criticism of the Fed chair, Jay Powell, talking up his economic policies and the tariff regime during a speech in Michigan marking his 100th day in office.
After decades of politicians who destroyed Detroit to build up Beijing, you finally have a champion for workers in the White House, and instead of putting China first, I'm putting Michigan first, and I'm putting America first.
Yeah, there we go. The speech to mark 100 days in office. Jill Deesis is with us here, our desk editor, to tell us really where we are in the Trump story. Let's start with any highlights from the speech.
Well, to me, David, this is really just kind of classic Trump. I mean, it really runs the gamut of criticisms against Fed Chair Jay Powell, him kind of saying, oh, like, I know you're not supposed to criticize the Fed, it's supposed to be independent, but he's not doing a good job. Just really, I think, kind of old hits there. He really kind of leaned into his defense of these tariffs that are obviously, not particularly popular. We've already started to see some rollback or some tweaks to how exactly these are actually going to take effect. We just saw him sign a couple of hours ago an executive order surrounding some of those tariffs on auto parts, kind of giving it more of a 2-year rollout to sort of ease automakers into the idea of moving manufacturing back, although then he turns around and says here, like, we'll give them some flexibility, but then we're going to slaughter them. So again, kind of like playing off that idea of, this conflict in Trump of, he's obviously coming out to defend a lot of his policies, but then in other ways, he's kind of been, forced to, sort of pare those back in certain ways. So I think you saw a lot of that on display in this speech. But yeah, I mean, this is still a Trump that's very much about defending his economic agenda.
And separately, also with Donald Trump, he did this interview with ABC, of course, and really, again, to your point, talking about the Fed, did that have more an economic flavor to it?
I thought what was interesting about that interview is actually some of the comments that he made on China, because we had, over the past couple of weeks, obviously, in the wake of that 145% tariff that Trump is, slapping on Chinese goods, he acknowledged that today that effectively amounts to an embargo on Chinese goods. But we have seen Trump and the rest of the Trump administration over the past couple of days talk about this idea that there could be some kind of negotiation between the U.S. and the Chinese, that there could be some kind of a trade deal. And, you had this interview where he, did bring that up to a certain extent, but then he's also saying, well, China deserves it, and they can offset the cost of these, and they can find other ways to sort of absorb the cost of these tariffs. And so, again, I think you see that kind of conflict playing out. But I think what's really important to note about whatever Trump says about China right now, we still don't really have any indication that, Washington and Beijing are actually sitting down and coming to the negotiating table and coming up with a concrete plan for how to resolve this and how to come up with a trade deal. A lot of it just feels a bit like bluster, but you kind of see Trump kind of reasoning that out and negotiating that almost sort of publicly in real time.
There we go. Jill, thank you so much. Jill Desis, there, our senior desk, news desk editor. And really just to underscore the point, right, so investors are trying to grapple with certain things. And I think fortunately and encouragingly enough, we're in the thick of number one earnings season. It's a very busy data week in the U.S. And, of course, we're going to get some numbers coming through out of China and PMIs this hour as well. So at least, to help understand and read the tea leaves, certain things are coalescing. You have soft data, which continues to be very, very soft. On your screens is the net monthly change in points on future expectations of U.S. consumers, right? And you had a massive 12-point drop, which is really one of the worst drops we've seen in the last, 35 years or so. So that's soft numbers that have come through so far. The other bits, in terms of hard numbers coming through, we have GDP numbers coming out on Thursday out of the U.S., and, of course, the jobs report, which our folks at Bloomberg Economics thinks will be the last solid reading before what they call the storm, and for the uncertainty to then show up in the labor markets. And at that point, Avril, might that then be an indication that the Fed might need to, in fact, look through the pickup in inflation expectations and then worry about what they need to do to backstop demand in the economy. So there's that, certainly. And, of course, there's all these earnings reports that have come through in the U.S., which I guess are also a tangible indication of how corporates really feel about this.
Yeah, drawing it back to the fundamentals, right, how they're being impacted by tariffs, if at all. And our U.S. colleagues have put it very neatly into sort of 3 buckets, where you look at the left side of your screen, those that think they've been really hit very hard. Some of them have dropped guidance altogether. I think about the likes of General Motors, right? Others who think that it's still too early to call it, can't quite quantify. We have Amazon also reportedly looking to display tariff pricing, and then others that say, for now, they think that the tariff impact is quite manageable. So that's what corporate America is saying for now. Flip the board and take a look, though, just recap U.S. assets overall since Trump's inauguration. And we've actually been seeing stocks dropping. Bitcoin is also down, as is the dollar, and 10-year yields. They've all fallen. So just keep that in mind, even as we see a bit of risk appetite coming back into the market. So let's take to today's market action now. Our senior equities reporter, Abhishek Vishnoi, joins me in the studio. So, Abhi, I've just talked through what we're seeing in the U.S., but just distill as well for us what we're seeing in China, because obviously it's been busy on the earnings front. We've seen how the banks are showing margin woes. They've erased some of their losses, though. Where do we go from here?
Well, if you look at the setup right now, China is being driven as a macro market. I mean, macro reasons are sort of weighing on how Chinese stocks should perform. if you look at month-till-date performance, almost all Chinese indexes are in the worst category. So they're worst in Asia. And I think Hang Seng China Enterprises Index has fallen about 5% odd. Now, where we go from here, it all depends on what China does. I think, our reporting is showing that a symbolic gesture, at least from Xi Jinping administration side, is needed for, US and China to sit on the table. Because otherwise, this trade war has become very concentrated on China. And the second aspect where it's becoming a bit more granular is that this is becoming a sectoral tariff war rather than, country-specific approach. So if you look at it from that lens, just because it's very concentrated on China and it's very concentrated on sectors, and China is factory of the world, even if its dependence on the US has gone down. So there is a lot more at risk for China, right? In that context, if they come to the table, there is some negotiation. You may see, a leg up. Otherwise, it is going back to the times of, having that, theme of EM ex China investment, Asia ex China investment. We have recently done a lot of stories which are sort of showing that global money is very reluctant to invest in China, even as the US exceptionalism part is breaking down, even as dollar is going lower, and it's expected that a lot of that money would chase opportunities in EMs like India, Indonesia, Chile, Colombia, and even parts of Europe and Japan. But that money is still very reluctant to come to China. So there needs to be some symbolic gesture on part of Xi Jinping administration to sort this issue. And second is obviously, people have been waiting for fiscal stimulus, like big bang fiscal stimulus, not drips. So, these two things can possibly change the game. Otherwise, at cost of China and probably to an extent US, we would see other EMs doing much better, even in May.
So that sort of geographical allocation that you've broken down for us. So when it comes to May, the setup, what is it going to look like?
So if you talk about May, the first thing that comes to mind is seasonality. I mean, the sell in May aspect, right? It's a weaker period seasonally, right? But I was taking a look, and over the last 20 years, the odds, I mean, if you have to go by them, are evenly distributed. So a lot would depend on how dollar does, and that means how this tariff war progresses. In that context, markets like Indonesia, parts of ASEAN, parts of Europe, because of the fiscal impulse there, and some pockets of Japan, they are expected to do better. Our reporting is showing that money is still reluctant to come to China, even if volatility has dropped because of state funds intervention. But there is one, silver lining there, especially for Chinese stocks, right? Our managing editor was making this point that how earnings season started on a mixed note, but there are some bellwethers who have done better. I'll go ahead and put this data out that if you look actually at 12-month forward EPS earnings estimates over this year, right now I think a lot of Chinese indexes are leading the upgrade. So definitely analyst optimism is there. They remain resilient even in the face of this trade war, which is becoming very concentrated on China. So very topical, reluctant allocation to China, but a lot more to other EMs, a lot more to other Europe. That's what the setup is looking like, for May or even for June.
Okay. Abi, great to have you in the studio talking through all this and what we should be watching out for in the next month. Bloomberg Equity Senior Reporter Abhishek Vishnoi. And we're counting down to the open of trade in Shanghai, Shenzhen, and Hong Kong. This is The China Show.
Concerned about the chaotic state of U.S. policy.
I think he's frustrated at this point. Certainly deployed a lot of leverage, probably more than was prudent, and now he's in a pinch.
This is really, killing the appetite from the world to the United States.
It's not commercially viable.
I think that will be the future. More localization.
I think probably less so on supply chain.
They're impacting sentiment, they're impacting people's
mind space.
We are focusing on the non-U.S. market for now.
We also need to be concerned about how our actual customers in the U.S. are going to react to this tariff increase.
And I think that's probably a good assumption.
You really see some fatigue of decision makers in manufacturing and also in the distribution sector.
It is literally still unfolding. The story is not finished yet.
It's about being again level-headed, calm, and come to the table for negotiation. I think that's the right move.
President Trump is a business person. He understands the value that Korean companies have placed in the United States.
Some of our recent guests with View from Asia on President Trump's first 100 days back in the White House. For more on this, let's bring in Gabriel Wildau, Managing Director at Teneo. So, Gabriel, first off, great to have you with us to kind of decipher all this, because it's been a very confusing, wild first 100 days. What do you make of this, particularly in the tariff narrative? Has he had to kind of soften his tone? How is this going to shake out going forward?
Well, I think what we've seen in the first 100 days overall is a much bolder, more confident president who's willing to act out on his pro-tariff impulses to a much greater extent than in his first term, where he was kind of operated on by advisors who opposed high tariffs. But more recently, as you note, we're seeing signs of pullback. We're seeing signs that the president really is sensitive to market pressure, despite the kind of bluster we saw from the speech today, where he claims that everything's going to be fine. But if we look at other comments from him and his advisors, we see that they are nervous and they are concerned about the impact on financial markets and on the real economy.
Are they nervous enough to, try to talk to China, work out a trade deal of sorts?
Yeah, I think we're in this kind of kabuki stage of the interaction where both sides are posturing. Neither side wants to appear as supplicant. Both sides want to demonstrate that they have greater resilience, that they can endure a trade war of attrition longer than the other side. But at the end of the day, both sides do want to de-escalate. Both sides do want to lower tariffs. And so eventually, I believe they will find a way to begin negotiations, because both sides want to do that. And it's the job of diplomats, after all, to solve these kind of image problems, to arrange a meeting between senior officials, or even a meeting or phone call between the two presidents, where it's genuinely unclear who asked for the meeting and who reached out first and who is the supplicant. And so that problem can be solved, and I think will be solved eventually. But right now, we're in the posturing phase, and that may go on for another few months.
Gabriel, David here. Do you think they are talking, though? And at what level?
Well, there's always going to be some discussion at the embassy level, at the low working level. There's always some day-to-day contact between officials, both in Washington and Beijing and in the embassies. But no, I don't think there are any senior level talks underway, specifically on trade. Secretary Bessent noted that there have been some of the normal consultations on financial stability, but I don't think that the trade talks have begun in earnest.
Right. Now, you've covered China as well in a previous life, let's put it that way, Gabriel. What's your sense of, when you look at Chinese media, the headlines coming through, the context there and how that's being framed, what is your sense, looking through that prism, in terms of China's willingness to do a deal?
I think China has signaled from the beginning that they're willing to make a deal, but they want to be treated with respect. And I mentioned this kind of kabuki we're in now, where China is doing a tough line now, but there's concessions that they are willing to make. For example, voluntary export restraints, I think, would be on the table. For example, a kind of redo of the purchase guarantees that we saw in phase one, some commitments on currency, some promised Chinese investment in key sectors in the U.S. like batteries and autos. So all of that is on the table, but again, it has to start with a show of respect. And for domestic political reasons within China, Xi cannot be seen as bowing. And in fact, I think he judged that, given the pain, the economic pain that are coming from U.S. tariffs, a show of fortitude was the best way to mobilize domestic political support within China to endure the pain that's coming down.
What about on the global stage, this charm offensive that Xi Jinping has been on, courting not just allies but potentially adversaries as well? What would a win for China look like?
I think a win for China in this context is simply dissuading third countries from aligning themselves fully with President Trump's trade war. I mean, in a best case scenario, of course, it's, they can form an anti-U.S. coalition around tariffs. But that's probably not going to be easy because in part because the U.S. security guarantees are still so important to so many countries. So they're not going to want to fully abandon the U.S. But I think it's a win for Xi simply if he can prevent what Secretary Bessent and others have said openly is a strategy, which is to form an anti-China coalition for those countries to restrict trade and investment with China. If they can prevent that, then the basic economics, the basic incentives that come with China's massive economy, because let's not forget 70% of the world's economies trade more with China than with the U.S. And of those, half have more than double the trade volume with China that they have with the U.S. So that alone creates a context in which, so long as those countries don't make a point of excluding China, China's going to continue to benefit from global trade, even in a situation where high tariffs on the U.S. Remain, because they're going to be able to use those third countries as a way to access the U.S. so long as those countries don't impose their own restrictions on trade with China.
Gabriel, thank you so much. Gabriel Wildau there, Managing Director at Teneo, joining us out of the East Coast in the U.S. And certainly that is a very good question to ponder. And as we go into the open today, has what Trump has done so far, I'll caveat that, strengthened China's hand in a strange way? Futures are pointing to the upside, the currency's at a one-month high, and we're very near the record low on the 10-year yield. Plenty more ahead. A preview of the open. You're watching The China Show. Good morning. Right, so in a few minutes we get the opening bell. We also get the official PMI numbers for April, and then 15 minutes after that we have the Caixin numbers coming out. Really the first indication of how the trade war and the tariffs have played out in the economy. Soft data, of course, in terms of the survey, and then we get into the hard numbers coming through in the next few weeks or so. But as you can see, it's already showing up, at least in the estimates. We are expecting to see a drop within the correction phase again on manufacturing. Within this, things like new export orders and new orders also as an indication of really how much orders have been withheld, and also things like inventory and how much of these containers have been piling up at ports currently. Avril.
Yeah, and showing up in earnings as well, right? We saw how the banks really showed that margin pressure. So we're going to be keeping a really close watch on financials when markets open. This is how we're setting up for the pre-market. You're watching The China Show. The open is next. This is Bloomberg.
Good morning. The Wednesday session is just a couple of seconds away. We're also waiting for the PMI numbers to come through. And it's the final session for April. And traditionally, April is historically a good month for equity markets. One of the best, in fact. It certainly hasn't been the case this year, but this year's been anything but ordinary. But we're going into May. And you know that old adage, sell in May. Historically, it's a weak month. And certainly the hope is, Avril, what's that, the Sinatra song? That's life, right? Flying high in April, shot down in May. But before you know it,
I had more of an
Xing
reference, actually. That is going to be May.
Yes,
David.
yes.
But, just all these pop culture references. Looking at, we have these Chinese PMI numbers, which I know you're going to get into in just a bit, but looking at the open, still pretty much a sideways trade, right? And don't forget, we also have mainland markets going into the golden week, so maybe not much in the way of big bets. The focus is really going to be, I think, as well, on some of these earnings scorecards. We've got the financials, the big Chinese banks, HSBC as well. And then, the Chinese president visiting Shanghai, does that provide a sort of lift in a way for the AI complex? So that's what we're seeing in terms of overall trading for the moment, starting a bit down actually on the Hang Seng.
Yeah, we're starting down, and of course we're also, as you point out, right, we're in the thick of earnings season. By the way, I'm just trying to busk here because we're still waiting for the PMI numbers, which actually should be out, and normally they don't usually drag their feet in terms of the timetable. So 9:30 is clearly what 9:31 right now. So I mean, while we wait for, here we go. Okay, there we go. Sorry, gave away the reaction there. 49. On the PMI numbers. So that should be coming in, if not below the lowest end of the forecast, at the very low end. The estimate is for 49.7. 50, of course, delineates the yes and no in terms of optimists and pessimists or contraction and expansion. Services PMI coming in at 50.4, also lower from the previous month and also coming in slightly a touch below the estimates, but yes, I mean, it is starting to show up as far as this goes. As you can see, dollar China is on the way up, some weakness coming through, 727.45 right now. Avril, but yeah, you're also getting some numbers coming through out of Oz.
Yeah, I mean, this is one economy that's going to be very worried about a China slowdown, right? So we're looking at inflation numbers out of Australia, looking at CPI, on year, bang on the dot, same as what we saw the prior reading just for the month of March. But we are, of course, been focusing on the trim mean on quarter because that seems to be the reading that the RBA is concerned with. We're seeing it coming at 0.7%, so a bit hotter than the survey and a bit of a pickup from the prior reading, although worth noting as well that I think markets have still been pricing in this 25 basis points of cuts for the next couple of RBA meetings. David.
Yeah, okay. There's so many moving parts to the story right now. Okay, let's just more context here on the April PMI numbers, right? So it did miss every single forecast with the exception of, I'm not going to get into specific names, but the lowest forecast coming in from SocGen, I won't mention the actual economist there, of 47.5. And also at 49, which seems to be the low end of the bell curve, if you strip out the extreme tail end of that. So coming in at about the lowest end of forecast here. Let's get initial reaction now from Robin Xing, Chief China Economist at Morgan Stanley. I guess without having seen the actual specifics on the data, what's your initial assessment of this?
It's definitely worse than expected. It shows tariff started to bite. If you look at the soft data, PMI is about the corporate sector. Yeah. We also run our own alpha-wide survey on the consumer sector. Both soft data are showing confidence started to be affected by the tariff shock. So in a nutshell, I think growth is slowing from here, given the tariff impact.
Why haven't we heard a more forceful response just yet?
Oh, good question. Last Friday, there has been a Policy Bureau meeting. Right. I think it's about, number one, giving us some forward guidance. If things keep weakening, they can come out with a new stimulus. But at this moment, the Policy Bureau meeting decided to speed up what has been pre-announced in the National People's Congress, that 2 trillion yuan stimulus package, local government debt issuance, infrastructure, some consumer subsidy program. They will speed that up for now. But I think over the next 2 months, when soft data like PMI or consumer survey we did start to be shown in hard data, like we already show some early signs from the cargo shipment, the container booking from China to US, they all declined quite sharply. So I think hard data will also reflect that weakness. Second quarter GDP could be tracking at around below 4.5%, meaningfully slower than the robust 5.4% in the Q1, and that could trigger more stimulus maybe by second half of this year. We are talking about another 1 trillion to 1.5 trillion yuan extra stimulus.
There's a theory out there, and I'm curious if you get your thoughts on this. So, one of the reasons they've held back on short-term aggressive monetary stimulus is the currency might actually be part of negotiations to keep the currency stable. I'm wondering whether or not you think negotiations might actually be at least keeping Beijing's hands tied on monetary policy.
Well, we do think monetary will play a role, but it's a minor role. They will cut RRR, they will cut policy rates only marginally. And on the currency, look, the trade war, the tariff shock, affected both countries quite significantly, U.S. and China. So it's not a surprise both countries' currency underperformed recently.
Right.
Dollar has been depreciating against the major currencies. PBOC just led the yuan to sit quietly behind the dollar. So if you look at USD CNY, it looks okay, but the CNY has been depreciating against the other major currencies, euro, yen. In fact, it has already depreciated almost 4% against its own trade-weighted basket. So going forward, we do see that pressure on renminbi. We are talking about the USD CNY could move towards something like 7.5, testing that level. But that means that the CNY will be depreciating more against its trade-weighted basket, given the dollar itself is also weakening.
That's right.
Robin, Avril in Singapore here. You talked about stimulus, maybe second half. What is the risk in terms of, the slower they take to execute it, the less effective it becomes?
That's a good question. I think the reason for this reactive fashion of policy is, number one, this is the first time we have seen tariff rate at such a high level. No one knows how long it could last. No one knows what's the real impact on jobs, on exports. It's the first time for policymakers, so they are watching that. Number two, I think they tried to accelerate what has been pre-announced in the MPC, that 2 trillion yuan first. They probably thought by front-loading this 2 trillion yuan, it can temporarily stabilize things for near term. Last but not least, they need more time to figure out what's the best way to stabilize growth with extra stimulus package, investment or consumption. I know this has been a debate in China since September last year when they started to address deflation problem. We always argued short-term stimulus on investment could help, but that's not enough. They need a deeper structural reform to shift from an investment-driven, export-dependent growth model to a consumption-driven model. But that requires deeper reform on social benefits, social welfare to cover migrant workers and farmers. And I believe policymakers believe that takes time. And even if you can build a better safety net with education, pension, healthcare, you don't know how soon households will spend. They may still choose to save rather than spending, at least initially. So that's why if policymakers are still worried about near-term GDP target, the most effective way, which is a tried and tested way, was always investment-driven. So I think they will take the middle path. After seeing weakened data in the next couple of months, they will add another 1 trillion to 1.5 trillion yuan. It's probably still dominated by investment side for tech, for certain infrastructure like this so-called old neighborhood upgrading program. That's probably not going to create too much oversupply issue, but over the medium to longer run, they will shift gradually towards that social welfare reform to boost the consumption. That's the middle path.
So this is going to be a multi-year sort of endeavor, shifting from supply to demand, consumer focus. But what is your sense of, you mentioned the tech sector there, the way in which it can help offset amid all these trade troubles? We hear how the Chinese president visiting Shanghai, a lot of AI headlines out of that.
Well, tech is definitely the bright spot. Even with all this persistent deflation, overcapacity could be more prolonged with the tariff shock. I do think China is turning more friendly to its own private sector in tech. I think the regulatory environment for big tech, for AI ecosystem will be quite transparent and stable. And unfortunately, that could probably encourage a partial return of animal spirit, but that's only narrowly defined in the tech sector. The top 5 hyperscalers in China will invest as much as 400 billion yuan in AI capex for this year. That nearly doubled from last year's 200 billion. But to a 145 trillion renminbi economy, that's still small. So tech itself cannot fully offset the tariff shock or get China get rid of deflation. They need more about consumption-driven stimulus and reform.
And I'm glad you brought it up because I know you mentioned this already, Robin, your Consumer Pulse survey, which you guys conducted, which I think is, I'm just looking at the dates here, April 8 to 11, so a couple of weeks back, but still fairly fresh. What other takeaways do you think we should know about this in terms of spending plans? What's the employment situation like, travel plans, if there's any insight here?
So if you look at Chinese exposure to U.S., U.S. is roughly 1/5 of China's exports, and exports is about 1/5 of China's GDP. So you can basically argue about 4% of GDP is related to providing goods to the U.S., and that's roughly 3% of Chinese employment. So we are talking about maybe 20 million people. Okay. So again, this extremely high tariff is too prohibitive for both countries to trade in any meaningful way. So for the U.S., it's a supply shock, creating inflationary pressure. For China, it's a demand shock, creating unemployment pressure. Now, to offset that, they definitely need to pay more attention to domestic services sector because services can create jobs. At this moment, it's all soft data. This alpha-wide survey we have been running is about consumers' confidence about the future. Now, at least 44% of the consumers we surveyed started to worry about jobs, being more concerned about their future income, and they quote the tariff shock as the number one reason. It's not being reflected in their wages yet, but it's showing in the soft data the confidence going forward. So we do think that's why they do need domestic consumption stimulus to offset this tariff shock.
This tariff shock for China is also prompting it to search for other markets instead of the U.S. to export there, because as you say, it's prohibitive. What are some of the markets that you think China is looking to?
Well, my take on this is if China does not shift its growth model from exports dependent to a consumption-driven one, as you said, firms, private business, they will naturally look for other markets. And other countries like Europe, they could be concerned about the potentially a lot of Chinese goods flooding into these markets, and that's going to hurt the domestic jobs. So in a few years, China may face tariff or trade protectionism from other countries as well. That's why essentially China needs to shift the growth model, focusing more on domestic demand. We noticed in the Politburo meeting, they started to talk about increasing household consumption, increasing household income, but we think a more sustainable way to deliver that is social welfare benefits to provide migrant workers with healthcare benefits, education. All of this will take time, but we are seeing some early signs. Inside China, the debate is gradually reshaping the consensus. There is increasing agreement that they should focus more on social welfare. And by doing that, they can probably reshape the narrative. Remember the Made in 2025, Made in China 2025. That achieved a lot of things with industrial policy, but it's also controversial. Led to a lot of geopolitical or trade relationship changes between China and the rest of the world in the last 6 years. Now we think they can upgrade that initiative to China Market 2030, focusing on using domestic, deeper structural social welfare reform to deliver a much stronger China market, China consumption. By doing that, they can probably ease the tensions, ease the concerns from other trading partners. Otherwise, as you said, firms will try to look for other markets, but if oversupply, overcapacity continued, that's going to create more problems, more backlash down the road.
Fantastic. Robin Xing, Chief China Economist there at Morgan Stanley. In fact, Robin and his team have recently, again, topped for, I think, a fifth straight year what some are calling the Oscars of the research world in the economics category. So, yeah, fantastic run there as well. Thank you so much. Right. Okay, we are just in time. I'm just looking at my time right now. We are about 15 seconds past the 45-minute mark. So we should actually be getting the Caixin numbers coming out. And yes, in fact, we are getting them as I speak. I only have real estate here for a couple of screens. Oh, okay. This one coming in well above estimates. 50.4 is the figure for Caixin. That's this private survey. It's a different sample size. It's also a different sample set. But yeah, put those two things together, and that's actually also softer compared to the previous months. Of course, the direction of travel is fairly consistent and clear. Plenty more ahead here on The China Show. Good morning. Welcome back. President Trump says China deserves the steep tariffs he's imposed on their exports, while predicting that Beijing will eat most of the impact. Now, easing, of course, underscoring the message there that he is easing the strain that U.S. consumers might already be feeling, in fact. Min Lo, our China correspondent, is here with us to talk us through what Trump seems to think that China will, what the impact likely is and where it's being felt.
Yeah, well, he seems to think that because China sells 5 times more to the U.S., that's why U.S. has all the cards and China is going to fold first. So he thinks China is going to eat the tariffs. But so far we have seen the likes of Temu actually passing on most, if not all, of the import charges to consumers for goods that are not being shipped from U.S. warehouses. The import charges are as high as 140%. And meanwhile, China's strategy seems to be the opposite. They are girding themselves for a protracted trade war. And meanwhile, you have these lower-level delegations going to places like Latin America, bringing Chinese companies with them, trying to seek new markets. And you have China also extending the olive branch to some of its rivals, with Japan, Premier Li Qiang sending a letter to the Prime Minister calling on both sides to jointly oppose these tariffs. Chinese ambassador to India also pledging that China will not be engaging in cutthroat price competition or dumping, and offering to buy more Indian goods to balance trade. And Korea as well, China actually hosting the first all-Korean pop concert next month, which is significant because the first time in 9 years lifting this informal ban that China put in place after Korea hosted a U.S. missile defense system there. So really trying to prevent this other countries from forming a united front with the United States.
Min, you've been tracking all things Chinese media, right? The narrative that's been coming out. The top story today is the Chinese president making a visit to Shanghai to visit an AI incubator. What's your read into how significant that is?
Yeah, so President Xi's trips always tell us something about the national priorities. And in this case, he is visiting Shanghai, which shows that China is perhaps nurturing Shanghai as the next AI hub. And we know there has been a lot of internal competition within China, a lot of competition between Shanghai, Shenzhen and Hangzhou to see who will be the next to come up with the next AI breakthrough. And President Xi is saying that this is a nascent industry, is an industry for young people. And you bet a sentence like that, it will be enough to motivate a lot of young people to set their eyes on this industry, because it's now being earmarked as the favored sector. That means that's where resources will be flowing to. Local governments from other provinces will look at this and think about how they should be rolling out their own incentives to promote this sector as well. And of course, this is taking on increased importance given the trade war, the potential for decoupling, and China sees this as the next frontier that is driving the next phase of industrial revolution in the future.
No, absolutely. And that's why there's so much focus on it. Our China correspondent, Min Lo in Hong Kong for us there. Thanks so much. Plenty more ahead. This is Bloomberg.
Right, welcome back. You're watching The China Show. We've had some time since the garlic's been sautéing on the pan, so we now can let that simmer a little bit, and we've had a look at the data a couple of minutes now. So a couple of things, right? On the PMI numbers themselves, the headline gauges missed forecast with the exception of the private gauge, which is a Caixin 1/3 on your screens at the bottom. Both sets actually coming in weaker than the previous month. In fact, on the manufacturing gauge, it came in not just weaker from the previous month. It came in at the very weak end. Not weekend, but the lowest part to the leftmost side, almost at that bell curve. 49, it missed nearly every single estimate, with the exception of Soc Gens. Right. Now, a couple of other things to tell you about here. So we're looking at things like new orders and new export orders. We're starting things off here with a look at the subcomponents, major subcomponents, and we're looking at new orders actually coming in lower, 49.2, which comes in contraction, and also is on an absolute level actually is equal to one of the lows we had last year. Interestingly enough, though, and I'm wondering, can I walk into the screen to point this out? Anyway, no, maybe not. New export orders at the very bottom, actually, just a second, 44.7. You know what? That does, yes, okay, that seems to be correct. Okay, we're looking at. You know what? I'm going to clarify that for you. Anyway, let's toss it back to Avril for the markets. Avril.
Yeah, I mean, to your point, the numbers do look pretty bad. It's a miss, right? And it's clearly in contraction. So really unsurprising how we're seeing the Hang Seng dipping, 0.6%, despite a pretty flat open. And of course, you see that sideways trade on the mainland. A lot of this may be investors reluctant to take big positioning ahead of the Golden Week, long weekend. For the moment, we are seeing maybe a bit of optimism on the Chinese tech sector. As far as AI, the complex is concerned, we'll have more. This is the China Show. Welcome back to the China Show. Here's a look at the Hang Seng half hour into the session. Certainly those PMI numbers on the headline, slipping into contraction, worse than expected. That's playing out. Even on the sub gauges, you're looking at session lows on Hang Seng Tech, Hang Seng China Enterprises. Dave?
Yeah, and I think to your point, what's interesting really is, the inspiration from Robin Xing, who joined us from Morgan Stanley early on. The two major players in this trade war conversation are really seeing their respective data sets and soft data really deteriorate fairly quickly, right? So this is the Chinese side. Overnight, in case you missed that, the consumer confidence numbers coming out of the conference board really showing a 12-point drop in future expectations. Is really one of the biggest drops there and over the last 30 years. So anyway, the reason I bring that up is U.S. futures are pointing to the downside right now after really what's been a decent streak of gains on the S&P, because we're then moving into hard numbers. GDP and the jobs numbers are coming out of the U.S. Towards the end of this week. 10-year yield, 4.16. On the Chinese 10-year yield, just to mention that, we're a couple of basis points just above there. The record low. Decent session so far, and I'm being extremely generous. That's 0.01, so at least you're seeing still some green on your screens right now. Okay, earnings to tell you about. AIA leading that. You have a couple of more names. HKX is coming out today in a couple of hours, and Yum China, of course, also set to report. Prada listed here in Hong Kong. That's also a gauge, of course, a window into luxury spending, which, by the way, they've flagged not just from Prada, but a lot of their sort of peers in the industry have flagged really weakness coming through there. Right. So we're about 85% into earnings season on MSCI China. You still have a lot of big names coming out. The big tech names, in fact, are still coming out around mid-May. All that being said, we do have a decent sample size. 60% roughly have missed, where you have data to compare estimates. 40% have beat. In line has been about 4 or 5%. Now, interestingly enough, so that's almost backward-looking. Forward-looking indicators like earnings trends, earnings projections, and the change in EPS moving forward, that's coming up on your screens across the different sector groups in MSCI China. Real estate and energy have seen the biggest revisions lower. Encouragingly enough, some of the consumer-facing names are seeing some decent upgrades year-to-date so far, 5 to 6%. IT, your tech names are up about 13%. These are more your hardware names as well. Just to give you, I guess, Avril, a snapshot of direction of travel here as far as the analyst community is concerned.
Yeah, and you just highlighted there among the earnings there, we've been trying to distill Hong Kong Exchange among them. So we'll be breaking that down a bit further, the results with CEO Bonnie Chan, getting her outlook on Hong Kong's IPO pipeline. And you can catch that interview here on The China Show tomorrow. Dave?
Yeah, I think I'm doing that interview later today, which reminds me, I have to prepare for that. I have, in fact. No, but we're waiting for earnings to come out as well. Lots to talk about with Bonnie Chan. In particular, we've had a lot of Chinese companies come out in the last 2 weeks or so, filing their applications to list here in Hong Kong, and actually what's been happening in the U.S. and China might actually be benefiting the exchange here in Hong Kong. Anyway, we can save that conversation literally for tomorrow. Joining us here on set is Stanley, who covers, of course, Asian equities for us here to just get us up to speed on earnings season. Why don't you start? What stands out to you so far?
Yeah, I mean, let's talk about HKEX first, just because you talked about it. It's gaining about 1.4%, as much as 1.4% in Hong Kong today after the earnings. The shares are up about 14% year to date. So it just shows, all this optimism that you have mentioned, and all of this is working on that profitability. All of this because of the average daily volume that has peaked so much, and that on top of the 2024's about 10% gain on top of all of this is just benefiting the bourse operator, and it's going back to end of January. Obviously, the deep-sea breakthrough that has funneled a lot of these investors into Hong Kong stocks. So we've been seeing that average daily volume just peak over and over again, and so Morgan Stanley expects about 28%, profit and revenue for the first quarter, and so it looks like it's going to be pretty good for the stock. Yeah.
Yeah. Now, we've had some companies report yesterday, right? I think it's PetroChina, Maotai, which is also some form of gasoline, if you think about it. Longi, Green, and Midea. Have we seen any sort of pronounced market reaction today to those names?
Well, Longi Green, we know that it's been waning because of that cheaper solar module prices, of course. The exports, even if they do it, it doesn't offset enough of that price discount. So, and it's just hit quite significantly by that tariffs. Of course, not only on China, but U.S. has hit that close to 3,500% tariffs on some of these solar products that's coming from Southeast Asia. And we all know that it goes back to about a decade ago when Longi Green and other solar makers have, gone to these other countries to actually, to kind of avoid these tariffs. Yeah. So it's hitting them hard. And of course, Midea, after its IPO, has been doing well. And of course, it's done well after a lot of these exchange programs and subsidies from the government. But again, the tariffs is coming in a bit problem for the company. Yeah.
Okay. Sang-Mi, fantastic. Thank you so much. Sang-Mi Cha, there are Asia Equities reporters. So we're just about 35 minutes into the cash market session in Greater China. Wrapping up really the last trading day of April. And you know what's funny about this? I've joked here live, and I've joked certainly on social media, that this is probably the most exhausted I've been since I've started my journalism, financial journalism career. And almost like the fate and the universe is just pounding me on the head with this. So after what's really been an extremely tiring month for many, many people because of the news flow, it's almost as if April didn't happen when you look at markets, right? So Asia Pacific Index is actually back to the highest level since the last trading session of March. It's almost as if Liberation Day didn't happen and markets have just quickly put that behind us. Is this hope, or can we trust the trend and momentum in these markets? Let's bring in Marcella, Chow, global market strategist at JPMorgan Asset Management.
Hi.
Given the uncertainty, are you surprised how quickly some markets have been able to retrace their steps?
Probably market is still, I think uncertainty still remains, and then volatility is still going to remain. So near term, market is still on a wait and see mode. That's why there will be some back and forth in terms of market performance. But in the near term, I guess with Asia,
Even though, yes, Asia has a lot of, for example, export-oriented economies like Taiwan, Korea, but it all depends on how the tariff negotiations go. And also, for example, Taiwan, Korea, due to how, for example, the semiconductor pause, that is a plus for those economies, and also because of the nature of the products, how complex and high-tech their products are actually. So even though as an export-oriented economies, they are actually irreplaceable. So even on that aspect, we still see value in investing into Asia, but diversification remains key. And also, right now, given how there's the diminished view about U.S. exceptionalism, we also continue to see how investors see value in, for example, diversifying globally across different markets and different sectors and different economies.
Does the trend continue, this diversification away from the U.S.?
Depending on how all these ongoing negotiations go, but recently we also see investors questioning or actually have interest in other regions except U.S. So this will likely continue. For example, interest into Japan, Europe, and India. And India particularly, given how they have been more ahead in terms of like bilateral negotiations, and also given how it's less exposed to the China supply chain and less dependent on the goods exports. So investors have been more interested in those that are less sensitive to tariffs. And they are finding also for like substitutes or those that can benefit from like transshipments, etc. So there have been more interest into ex-US. But we continue to see also within U.S. Across sectors, other than the Magnificent Seven, there are also sectors that have benefited lately. Those probably also that are less sensitive to tariffs too.
What about Japan, Marcella?
Japan, I guess this also depends on the ongoing auto tariffs negotiations, because yes, we continue to see, for example, long-term structural benefits. For example, in recent earnings season, we see various companies announcing larger than expected share buybacks, meaning they have confidence in the outlook for their own companies, and they are more focused into like paying back to shareholders and focusing more on the corporate governance reform. But then near term, the auto tariffs will make negotiations that are ongoing, and the lack of clarity means that with Japan focusing so much on autos, that might actually have a hit on the Japanese economy. But one thing that is worth mentioning is that Japanese economy has not, even though the GDP may have been, GDP growth has been relatively muted, but then the earnings growth has actually far exceeded that of the GDP growth. So even though GDP may come into attack or come under with some sort of decline, we continue to see value and also earnings growth going forward, given all these structural trends that are supporting the Japanese outlook.
So resilient in Japan, you think, and maybe some opportunities in India as well. How much of all this comes at the expense of China? In other words, how are you repositioning when it comes to Chinese assets?
In terms of China lately, we do see, for example, data that continues to, for example, IP data, etc., that are exceeding market expectation. But we believe those are because of front-loading of exports, and market continues to focus on, for example, ongoing U.S.-China trade negotiations that continue to remain a lack of clarity, and also recently with the press conference and also with the Politburo meeting that seemed to be under-delivering, and market was a bit disappointed with the stimulus measures that haven't been delivered just yet. But we believe that Chinese economy might actually start in the first stage, first deploy what is currently available, the policy options, and then wait till there are more clarity on trade negotiations, and then might actually escalate that stimulus. I believe the next signpost might probably be June, when 12 million fresh graduates might come into the market and enter the job market, and we believe the Chinese economy might focus more on the employment stability over the GDP growth in the near juncture.
I'm looking at the changing narrative around the Fed. The hard data has been so far okay. Soft data has been just gone off a cliff. Yeah. Where do you think rates will be in 3 months' time? And what does that tell me as far as if I'm tempted to go into cash short term as an investor. What do you think? How does that inform me?
Right now, yes, Fed is still in a wait-and-see mode, but we believe, for example, this week on the labor report, we probably won't see any big changes just yet. But probably in the June report, we might start to see some impact. And when the labor growth number starts to show negative or contraction, then that might give enough signals for the Fed to probably start easing in March or July. And we believe that the Fed later on for the rest of this year might do 2 or 3 more cuts. In terms of, there have been clients asking about our view about the Fed, whether they are going to see the tariff impact more or actually focusing more on the growth impact. We believe that they might see through the inflation impact and probably still going to cut and to support growth in the near term.
What about the long end of treasuries? Do you think the worst is over there?
Lately, after 2 weeks ago when we saw like a 50 basis points increase in treasury yields, we've seen treasury yields actually came down close to 30 basis points, probably because there has been actually a bit of a mismatch between equity market and fixed income market, and that we see equity market applauded the tariffs walk back, while the fixed income market these days are more focusing on the potential risks from tariff or the uncertainty brought by tariff that will lead on to growth downside and the growth risk. So we've seen the yield actually been retreating and actually coming down about 30 basis points. So I guess the market is also still focusing on the ongoing trade negotiations and whether there will be less back and forth between the negotiations and also from the White House administration.
What about income strategies, given the current environment?
Actually, investors remain very focused on income and trying to actually find products that can still offer income. Where actually we were actually offering, for example, from fixed income, from equities, we saw stock dividends, and also from, for example, from private assets, focusing more on infrastructure and transportation, and also like option overlay strategies. Those will continue to help investors to manage volatility, especially if uncertainty continues to remain escalated and volatility might stay for the next few months.
And those are recession-proof largely, as if people are concerned whether the uncertainty hits those yields just very quickly on
Indeed, like a portfolio, 60-40 portfolio, a lot of clients have been asking whether we should actually do a park in cash.
Right.
But then actually from our analysis, we see that 60-40 portfolio with stock and bond continues to actually outperform cash in a 3-year period, despite all the market shocks in the past, in the history. History doesn't foresee or actually doesn't tell, hopefully, we don't have a crystal ball, but we continue to highlight how we should not time the market and should stay invested at all times.
Fantastic. Marcella, thank you so much. Marcella Chow there, global market strategist at JPMorgan Asset Management, really underscoring just the long list of options you might have if you have cash. And I think the advantage of not having any is you don't have to be inundated with such complex decisions, right? Coming up here on the China Show, I speak on behalf of many of us, aren't I? Right, we're talking Chinese travel here. We're going into a period where, you have a long weekend in Hong Kong. You have a holiday, of course, on Thursday and Monday. So we'll look at travel trends, particularly as it pertains to luxury and high price point travel with Todd Handcock joining us in a couple of minutes. Plenty more ahead. You're watching The China Show.
Concerned about the chaotic state of U.S. policy.
I think he's frustrated at this point. Certainly deployed a lot of leverage, probably more than was prudent, and now he's in a pinch.
This is really, killing the appetite from the world to the United States.
It's not commercially viable.
I think that will be the future. More localization.
I think probably less so on supply chain.
They're impacting sentiment, they're impacting people's mind space.
We are focusing on the non-U.S. market for now.
We also need to be concerned about how our actual customers in the U.S. are going to react to this tariff increase.
And I think that's probably a good assumption.
You really see some fatigue of decision makers in manufacturing and also in the distribution sector.
It is literally still unfolding. The story's not finished yet.
It's about being again level-headed, calm, and come to the table for negotiation. I think that's the right move.
President Trump is a business person. He understands the value that Korean companies have placed in the United States.
Yeah, just some of our recent guests, their view on, view from Asia on what's taking place, of course, just about across the world with Donald Trump at the White House, first 100 days in office, of course, we're marking that currently. In fact, just on that very note, Goldman Sachs CEO David Solomon says that he is expecting markets to settle down after really experiencing extremely wild swings in those first 100 days of President Trump's second term. Speaking exclusively to Bloomberg, Solomon also told us that he is waiting or awaiting more clarity on the direction of the president's policies.
We're 100 days in, and I would say there are a handful of policy initiatives that are being put forward. Some of them certainly are very, very interesting and intriguing to the market, but what's been put forward on trade so far has raised the level of uncertainty very significantly. And so I'd say 100 days in, we need another 100 days to kind of see where the policy directives are going and to try to have a better understanding of how what's talked about so far, particularly with respect to trade, is ultimately going to be put in place, how it's going to play out. But the policy actions to date have raised the level of uncertainty to a degree that I don't think is healthy for investment and growth. And I think it's going to be important that we get more clarity on the direction of travel from here.
What, for the markets? So if you look at markets, there's been a sell-off, a pretty dramatic sell-off in U.S. assets. It's somewhat come back, but has it been too drastic?
Well, it's not just for the markets. You know, first and foremost, it's for businesses, it's for individuals. When there's a high level of uncertainty, people tighten their belt, they invest less, they spend less, and all those things slow down growth. And so, you know, one of the things that has happened over the course of the first 100 days is that the perspective on forward growth has been decreased. And so when you decrease, you know, that perspective on forward growth, that changes investors' perspective of equity values. So what we've seen is a relatively orderly kind of repricing of equity assets. And what's unusual in the context of this repricing is generally when you have that kind of equity market stress, people run to treasuries or safe haven, but here we're seeing a slightly different rotation because of the nature of the policy. We've seen a weakening of the dollar, you know, at the margin, and so that's been different than I think what people expected.
Well, are treasuries still a safe haven?
I think U.S. treasuries absolutely are a safe haven, but you can reprice a safe haven asset as people's preferences shift slightly. You know, I think at the margin, we've had for a long period of time a trend of capital flows into U.S. assets. And, you know, at the margin, people are looking at their portfolio constructions and saying, given the uncertainty that's been raised in the U.S., do we want to rebalance that a little bit? And I'd say the rebalancing so far has been at the margin. Investors can rebalance their portfolio in two different ways. If you're over here in Europe and you have a European investor, they can sell U.S. assets, but also if the relationship between the dollar and the euro changes, that rebalances their portfolio weighting too. And so we've seen that over the course of the last few weeks.
And that was a Goldman Sachs CEO, David Solomon, speaking exclusively with our colleague there, of course, Francine Lacqua. And, you know, for our Bloomberg clients, you can catch that specific interview or others that you might have missed here on our programming, of course, the last 24 hours or so. Certainly lots to get caught up on. TV Go on your Bloomberg terminals. This is Bloomberg. Welcome back. Here are some major stories that we're following today. Amazon says it will not display the cost of U.S. tariffs on products after President Trump called Jeff Bezos to complain. Now, shares paired earlier losses inflicted as the White House described the idea as a hostile and political act. Now, the proposal was initially reported by Punchbowl News, but the company now says the tariff label is not going to happen. Now, Bloomberg has learned that President Vladimir Putin is insisting that Russia take control of 4 regions of Ukraine it doesn't fully occupy as part of any agreement to end the war. Now, the demand deals a blow to President Trump's efforts to reach a ceasefire. Sources in Moscow say that U.S. envoy Steve Witkoff tried during lengthy talks last week to convince Putin to agree to a ceasefire based on the current front lines. Right, just back to markets, and speaking of current front lines, earnings to get you through. Samsung will start things off. They're 0.5% to the downside, really unpacking the earnings story there for them. As it pertains to chips in particular, it's maintaining its forecast there for HBM4 production in the second half. It's also looking at multiple customers there on custom HBM and HBM4. Sony, going into the Japanese lunch break very quickly here, up on spin-off conversations maybe for its chip business. Banks in focus here. Chinese banks very quickly have some of the biggest, of course, reporting earnings. Reaction to the downside right now. And speaking of those earnings, I'll leave you with a look at thinner bank margins compared to the previous quarter. There you go. Plenty more ahead. This is the China Show. Right, good morning. Going into the Japanese lunch break, and we're actually doing okay. So we started the day off actually with just a general lack of momentum. A good thing there was a lack of malaise, if you want to put it that way. 0.25% to the upside on the broader topics gauge. We are, of course, going into the window tomorrow. It's around this time tomorrow. We might actually get the BOJ decision this time. We'll definitely get it tomorrow. Just going into, effectively saying in 24 hours from now, we'll be going into that. So look at second derivative indicators like, dollar-yen implied vol over the next 24, which I imagine should be picking up ever so slightly. They're not expected, though, the bank to do anything as far as some of the headline measures are concerned. Asia-Pacific, 0.25% to the upside on price. Right. The rest of the markets, though, in terms of just a sort of cross-section across sector groups, most on the way up, with the exception of a few. Energy, of course, which has been really a weak spot in the commodities complex with low 60s on oil. Utilities also in the back foot. Industrials also a bit of red there as well, which takes us really into this sort of quiet, interesting, truncated trading week in Hong Kong, if you will, because we are going into holidays. In fact, most of the Asia Pacific will be shut this time tomorrow. Mainland China specifically, in fact, begins its 5-day Labor Day holiday tomorrow, and you have immigration authorities expecting inbound and outbound trips for the period to jump about 30%, nearly 30% from this time last year. Let's talk about industry trends and data and what we're seeing on the ground. We're joined right now by Collinson International, an airport experiences and loyalty programs provider, and also the operator, you might know this, Priority Pass, if that doesn't sound familiar to you. I'm sure it does at this point. Todd Handcock is their Global Chief Commercial Officer and APAC Executive Chair, who joins us right now from Singapore. Todd, good morning and a pleasure to have you on the show. Quite a window you have into travel data. Why don't we start with that? What are you guys seeing this year compared to last?
We do, David. The great thing is because we have Priority Pass within our business, we have about 1,700 airport lounges and experiences across the world. So it gives a pretty good bellwether in terms of what's real-time happening. And what we're seeing is really interesting in terms of the first quarter. While we've got some macroeconomic challenges and headwinds in the space and geopolitical challenges, what we're actually seeing is, for our visits into our lounges, our airport experiences, about 4.2% increase versus the same quarter last year. Now, that's balanced by about a 2.8% reduction in global travelers going into the United States. But interestingly, 17% increase in U.S. travelers moving to other parts of the world. So what we're seeing is some rebalancing of where people are traveling to and from.
Right. In fact, I was wondering if we could talk more about that, because that's interesting. Where are you finding, and correct me if I'm wrong, 1,700 lounges globally. That's an interesting footprint that you guys have. What are the busiest markets?
Right now, the two busiest regions are Asia Pacific and Latin America. And if I zero in on Asia Pacific, 51% of all travel growth globally last year happened within the Asia-Pacific region. In China, we're leading into Labor Day holidays. We're seeing about 750,000 outbound trips already booked for the holidays. We're seeing a 28% uplift for Chinese travelers into Japan and Korea. So that's significant. The other thing that we're seeing really interestingly is Southeast Asia as becoming a travel powerhouse. So a lot of travel into Thailand, Malaysia, Indonesia, and we're seeing 17% increase in global travelers into the Southeast Asia region.
Why do you think things are holding up?
What we think is really interesting is there's a couple things. One of them is obviously in Asia Pacific we have the largest middle class economy, but we're also seeing a significant trend of millennials and younger moving towards more experiential and almost transformational shift for the travel industry. So people are looking for to spend their money less on things and more on travel experiences and, as I say, transformational experiences. So experiences that give them a different perspective on the world, not just go and sit on a beach, but maybe go to a yoga retreat and then look for a spiritual journey, or go on safari in Africa and actually help in villages. So we're seeing a lot of changes in terms of consumers, specifically in Asia Pacific, and how they want to spend their dollar.
Right, and are you noticing those same trends with a sort of younger market, mainland Chinese traveler market, for example? What trends are you seeing as far as consumer behavior there is concerned, specifically?
Absolutely. So when we're taking a look at outbound travelers in China, you're sitting at about 60% of outbound travelers in China are below the age of 30, and around 60% of those are actually female. So you're seeing a couple of really interesting demographic changes for China in terms of that outbound looking to experience the world. And it's important to say that China's taken a little bit longer to recover from COVID. This year, 2025, will be the year that actually China outstrips the 2019 travel numbers from China.
Right, and people are trying to figure out businesses. I mean, I can speak at least anecdotally on behalf of when you look at what the Hong Kong tourism sector is trying to, I guess, evolve into is really the changing habits of younger generation, experiential, pictures more than booze, anecdotally. How is that changing the way you plan your product?
Yeah, I mean, we've done a lot of studies around sports and music tourism, and so Hong Kong's a great example. So you had the Coldplay concerts there a couple of weeks ago, 200,000 attendees over the series of the concerts. 35% of those were international inbound. So Hong Kong Tourism Board is doing a good job of creating that anchor, and that demographic is primarily the millennials and younger that are traveling for that. We can see here in Singapore, where I'm based, an uptick in searches from India, from the UK, from Australia, and from Taiwan associated with the week that Lady Gaga is going to be having her concerts here. So you're seeing that shift to experiential being a very important piece. And in our research, 81% of sports and music fans have said that they've traveled to a different country, a new country, specifically to see their favorite team or their favorite artist.
Right, and Todd, I'm wondering if you could also talk about, so far I think we've discussed largely indirectly air travel. One thing that's really picked up since the the COVID pandemic is really the high-speed railway network, particularly around Greater Bay Area, across mainland China. And I'm wondering how that affects companies like yourself that are maybe looking to sort of leverage on how people travel as well.
Yeah, that's really interesting because China obviously is investing a significant amount in high-speed rail. We're seeing the same thing coming in Indonesia and in Vietnam soon. Last year, we set up a joint venture with a company in China, which was very synergistic to ours because they run railway lounges for the high-speed rail network across China. So we've brought both the air travel and the rail travel together, and now we have coverage of lounges across that entire high-speed rail network with Joy Tour Priority Pass, that joint venture in China. So we're very much doubling down where we see the increase of rail.
Todd, a final question for you. And I don't mean to end this on a negative note, but I think it's interesting from an objective point of view. You mentioned less travel to the U.S. at the start of the interview, and I'm wondering, what are you seeing exactly there? Because anecdotally, certainly you and I know there has been a drop in travel into the United States.
Yeah, I mean, as I say, it's about a 2.8% reduction in global travelers that we're seeing going into the United States right now. We are seeing an uptick in domestic travel in the United States. We're seeing in Canada people traveling more domestically and both east and west instead of south. But at the same time, the American travelers are traveling internationally. They're traveling 17% increase from what we're seeing in terms of visits to our lounges and our facilities.
Fantastic. Todd, as you underscore there, certainly data is irreplaceable when you look at these trends. Todd Handcock there, fantastic. Thank you so much for the time, sir. Global Chief Commercial Officer, then APAC Executive Chair at Collinson International, joining us live out of our bureau in Singapore. Plenty more ahead here on these markets.
China probably will eat those tariffs, but at 145, they basically can't do much business with the United States. And they were making from us $1 trillion a year. They were ripping us off like nobody's ever ripped us off.
That was President Trump. They're talking about the tariffs that they, of course, were imposed on China as he marks his first 100 days off his second term, how China will be eating those tariffs. Right, let's bring in Min Min Lo, our China correspondent here, and certainly context here, because the U.S. president does seem to think that China will be kind to U.S. consumers here.
Yeah, certainly he's trying to play down the impact of inflation on Chinese consumers, but already you have seen those big e-commerce players like Shein, Temu already passing on the prices of these import charges to consumers, sometimes as much as all of the import charges, as high as 140% or even more. And meanwhile, China is girding itself for a long, protracted war. It doesn't seem like they're urgently trying to de-escalate things with the U.S. either, but they're focusing their attention on not just helping their exporters, but also really reaching out to all the other countries around the world, convincing them not to join the U.S. in creating this united front to contain China. So just this morning, I think we have the Chinese Commerce Minister calling on Chile, saying that these tariffs hurt everybody. And you have, China hosting the first all-Korean concert next month, which is quite significant because that means they are lifting this informal ban that has been in place since 2016 in retaliation to Korea hosting some U.S. defense missile systems there. And then the Chinese Premier Li Qiang wrote a letter to Prime Minister Ishiba in Japan, calling on Japan to jointly oppose these tariffs. And also with India as well, the Chinese ambassador to India pledging that China will not be engaging in these cutthroat price competition, pledging to buy more Indian goods in order to balance trade. So really trying to go on this charm offensive. And let's play this little clip that is being published across Chinese state media on X, on WeChat in Chinese and English. Take a look.
Kneeling only invites more bullying. China won't kneel down because we know standing up for ourselves keeps the possibility of cooperation alive, while compromise snuffs it out. China won't back down, so the voices of the weak will be heard.
So that's a 2+ minutes long video, and it really shows or cited many examples of how the U.S. has been a bully in the past, cited how U.S. has in the past curtailed Japanese exports in the 1980s and then used the Plaza Accord to basically push Japanese economy to slow down for decades, and just reiterating this point that U.S. is the bully and China is this champion of this rules-based international order.
Yeah, and I guess meanwhile, though, they've also been busy with the other focus of how they're looking to I guess, insulate their economy. Things like domestic AI consumption. And of course, in focus was the Chinese president's visit to this AI incubator in Shanghai.
Yeah. So this also has been the front page on many Chinese state media, Xinhua, People's Daily. And essentially, it shows you how China is prioritizing or nurturing Shanghai as this next AI hub. And you can see President Xi actually trying on an AI glass and AI glasses there. And he said that this is a sector that is nascent. It is a sector for young people. And that's going to likely inspire a generation of young people to really, eye this industry as the next one, the next big thing that is going to be, hiring a lot of graduates. That's where resources will be pouring into. You can imagine that all of these different provinces will be competing with each other to outshine each other when it comes to these AI breakthroughs, pouring more resources, more incentives for companies to invest. And there you can see on the board there, all of these AI gadget makers are seeing quite a big jump in their share prices because of this signaling from the Chinese government. And of course, the backdrop is that intense competition, potential decoupling when it comes to the tech sector with the U.S. as well.
There we go. Min, thank you so much. Min Lo, our China correspondent there. I hate to highlight the point that Min was just making there, right? A visit is really descriptive in many ways of policy support and priority. So, it's not just that on the AI space, right? So we showed some of the reaction there. On the earlier point that Min was making, I'll get to the PMIs just in a moment here. Some of the Korean entertainment stocks, right? Up on the back of this lifting of this informal embargo of K-pop onshore. Anyway, at least that's something to think about. Okay, the other thing we want to point out is about an hour and 15 minutes back, official PMIs, an hour back, almost on the dot here are these PMI numbers for April. So takeaway, trade war has showed up in some of the soft data, forward-looking indicators on survey-based indicators here. So manufacturing actually coming in at almost missing every single forecast out there with the exception of one. Non-manufacturing also maintaining still at least above 50, which is still expansionary, but as you can see, not just a drop, but also a miss compared to estimates. We also have, by the way, do we have the chart as well on top of this that we can show actually visually? To all my producers, if you don't have the chart number, I'm just going to bring that on my screens right now to give that to you. So, for a look at the components there. So, on a number basis, right, actual versus prior, a drop across most, if not all, specifically as it pertains to export-oriented PMI readings, right? So, you have new export orders on both manufacturing and also non-manufacturing, yellow and blue. On a greater scheme of things, you take that all the way back now. So that massive drop that we have takes you all the way back nearly 2.5 years ago. So it's starting to show up in the numbers, and the point I think Robin Xing out of Morgan Stanley was making earlier on. Perhaps the reason why we haven't seen more forceful policy offsets coming out of Chinese economic officials is so far the hard numbers haven't quite reflected what the soft numbers are already pointing you toward as well. Anyway, keep that in mind. And as we move into the thick of earnings season number one and economic numbers for April, which over the next few weeks or so we'll be, of course, sinking our teeth into. Right. We'll table that for now. On the investment front, so more coming up here on Donald Trump's first 100 days in office on Insights with Has, of course, coming up at those times, which is effectively in 13 minutes from now. Mark Mobius, chairman of Mobius Emerging Opportunities Fund, joining us, of course, on those times on your screens. Stay tuned for that conversation coming up with Has out of Singapore. Plenty more ahead here. This is The China Show. Welcome back. Here are some major stories we're following today. Let's start things off with AIA. there we go. Yeah, no rhyme intended there, but just worked out to be that way. Stock is up 5% here in Hong Kong. The company saw a 13% rise in first quarter net business value. That's up to about $1.5 billion after factoring in exchange rate fluctuations. The firm says profitability was propelled by strong sales in core markets, including mainland China and also in Hong Kong. Now, Chinese clients continued to seek investments in offshore assets despite threats of turmoil in global markets. Right, big move up. Down at least overnight here. Super micro shares tumbled quite substantially, as you can see there on your screens. That's after prelim results falling short of estimates. Sales for the third quarter actually coming in at $4.5 to $4.6 billion. You're missing the company's own guidance of $5.5 billion. Now, the server maker pointing to the underperformance to customers delaying purchases into the current quarter. Now, UPS says it expects to cut 20,000 jobs this year and close dozens of facilities as shipments for Amazon fall specifically. Now, the company says the overhaul is in response to expected lower volumes from its current customer and should save $3.5 billion this year. The Teamsters Union says UPS will be in for, quote, a hell of a fight if it tries to cut members' jobs. Right, Starbucks shares are, what are we doing in late trade? Coming up shortly, down 8.5%. It's at 6.5%. Okay, there we go. Get my eyesight checked here. That's after same-store sales declined 1% in the last quarter, missing estimates as well there. So earnings per share also disappointed. You have CEO Brian Niccol says that the chain is making progress in turnaround plans despite weakness in the latest quarter. China was also a bright spot with sales coming in better than expected. Right, now speaking of earnings, the Chinese banks are the biggest decliners right now, as you can see it, I guess, in terms of points given the weighting, and percentage-wise, it's not doing well. Numbers where, the margins specifically did show, of course, policy support, margin pain, really front and center there. Latest to come out with a change to ratings. Last we checked, this is UOB. Cut to hold at the broker, their price target for CCB8 shares at 7 Hong Kong dollars a pop. Now, silver lining, of course, is dividend plays. A drop like this certainly increases your dividend yield substantially today. So something, of course, to look at, of course. That's the information. You make your own decision, of course. Right. Bank margins to the point we were just making there, right? So a drop, more than enough, really. 1.3%, BOCOM 1.23%, just under 1.3 there. And as you can see from this time, not this time last year, but from the end of 2024 calendar year, that's seen, of course, a fairly noticeable, sizable drop there as far as income margins are concerned. Okay, several other things. We talked about AIA, that was down. BOCOM, of course, down as well, 3.2% to the downside. And yeah, speaking of earnings coming through in, I think HKX should be reporting. Interesting enough, we should be knowing. No, I think they should be reporting at 12. Here's what I think, and this is just make me thinking out loud in my head. If the exchange operator reports results, does it submit the filing to itself? Anyway, right? Anyway, we'll be breaking down. I might actually ask that question to Bonnie Chan. We'll be speaking with her, and we'll be playing out, of course, that interview for you. Coming up, of course, on Bloomberg TV, Bonnie Chan, CEO of HKX, and of course, really, the pipeline of IPOs moving forward, and has what's been happening outside really benefiting the pipeline as far as a lot of the filings taking place into Hong Kong. What are the big names to watch? Delisting concerns in the U.S. might be another thing. Anyway, you can watch an interview here on The China Show tomorrow.